Welcome to the Real Estate, Fitness, and Nutrition Podcast. I am your host, Heather Ford.
And I am Chuck Ford, your co-host, and we're really happy to be here with you today.
This show is about the things that we do best, real estate, fitness, and nutrition. Today, we are going to be talking to you about interest rates and how they are increasing right now.
Right, and it's a subject that everybody in the real estate market and buyers and sellers and agents and brokers are all concerned about and taking note of, but we're kind of here to give you some more information and tell you a little bit about the history also.
Right. So you've heard time and time again how crazy the real estate market is right now. I would use the word fast to describe it, which does make it a little bit crazy. So there are homes for sale, but they are just going under contract like that. So one of the things that Chuck and I tell everybody who we talk to about buying a home is that one of the first things you want to do is to contact a local lender. I could get into the reasons why I say local lender, but just trust me, they are the experts in your area. So contact a local lender. They can help you figure out, first of all, how much you qualify for, how much of a loan you can get. They can help you budget and figure out what kind of monthly payment that you're going to be comfortable with paying for your mortgage. And then from there, they can help you, if they need to do some kind of, financial counseling, they can give you ideas on what you can do to save more money or qualify for a different kind of loan or things like that. So they are the people that you need to contact before you even begin looking at houses for sale. And then it's also important for Chuck and I as real estate agents because we don't want to be showing you $500,000 houses, $500,000 houses, when you can only qualify for a home up to $300,000. Right. Or vice versa, we don't want to show you $200,000 homes when you could get a house for $300,000, and there's so much more you could get in that $100,000 gap.
I can tell you just from experience how disheartening it could be because buying a home, yes, it's a business decision, and it's probably the largest amount of money that most of us are going to spend in our lives, especially in our personal lives. But it's also very emotional. I mean, know when you walk into to a home, especially first-time home buyers, you walk in and you're like, oh, this is it. This is where I want to live my life, where I want to raise my family, where I want to do things. And then to be turned around and be told, well, we're sorry, you can't afford that. Yeah. It's disheartening. So that's why we always stress, hey, check out with your lender. We want to make sure that you're qualified for what you're looking at.
Yeah, even if you know that you are in a pretty good situation financially, maybe you get in there and you realize, oh, the payment's going to be that much. I don't want to pay that much. So, it's just a really good idea to do that first before you get emotionally attached.
Especially with the rise in interest rates, because what you qualified for 3 months ago may not be the same as what you qualified for. So you're going to tell us more about that.
So that's kind of what we're going to dive into a little bit today. If you haven't heard, interest rates, and we're talking specifically about home loans, are increasing, have increased already, and are going to increase throughout the year. So an interest rate is your payment for borrowing money. It's the cost of getting a loan. So your interest rate is going to be calculated into your monthly mortgage payment. So it could have a pretty substantial impact on what you're paying for your mortgage. And just a little bit of background, I'm no expert. We do plan to have an expert on the show at one point, but that's not today. But a little bit of background, the Federal Reserve is what drives interest rates. So they had a recent increase, I think, at the beginning of March. And that means that whenever they have an increase, interest rates are going to follow. And they plan to have several more increases throughout the year. So we can expect interest rates to get a little bit high. Chuck, did you look to see what interest rates were today?
I didn't. I can look real quick, though.
Yeah. Well, I think the last time I looked, it was 4.35. And that was maybe a few days ago. Okay. So historically, over the last year or so, interest rates have been as low as 2.5%. Would you say that's
Right,
correct?
Yeah, that's what we refinanced.
So yeah, we refinanced our own home for that low. So 2.5% is super low. Now interest rates are over 4%, and that's kind of the bottom. Your interest rate will vary depending on certain things like your credit score and amount of debt to income ratio and things like that. But the lowest interest rate right now, I think, is around a little over 4. So that's really going to play a difference in what you can afford. So Chuck is so much better at numbers than I am. So he has an example that I actually found in a news article, but he came up with himself first. And I'm like, hey, look at this. And he's like, yeah, I know, I already figured that out. Anyway, so he has an example of how the rising interest rate can impact you as a buyer. So I'll let you go ahead and explain that example.
Real quick first, just looking at Googling interest rates for today, it is saying that the 30-year fixed rate is 5.060.
Ooh, yeah, so it's gone
and
up.
it fluctuates on a daily basis,
Yes,
literally.
yeah.
So getting into our example, and I'll try to keep this basic as possible because that's just the way I do things. When you pay, if you borrow money in most states, and we pay to the bank a certain amount each month, and that amount includes your principal, which is the amount you borrowed, your interest, which is the cost of borrowing the money, and it also includes taxes and insurance. So taxes and insurance are not going to be affected as much by the interest rates,
Right.
if at all. So we're going to take those out of the equation, but we can talk about those at a later date. But taxes and insurance are going to stay out of this equation. So we're just going to look at the principal and interest. So let's say you could afford $1,000 a month. Let's say you could afford $1,600 a month for your house. You're probably going to take $500 or $600 off for your taxes and
Right.
your insurance.
Yep.
So
that tracks.
So we're going to say you can afford $1,000 a month for the loan of your house. So if you were to borrow money at that 2.5%, which people did just a few months ago, $1,000 a month on a 30-year fixed rate conventional loan, you would qualify for $253,087. So you could buy a $250,000 house for $1,000 a month in principal and interest. Pretty good price.
Yep.
Now, if that goes up 0.5% to 3%, that same $1,000 will only qualify you for $237,189.
Okay.
So you have lost $16,000 with 0.5%. It goes up again to 4%. From 3% to 4%, you're down to 209.
Oh, wow.
So now
That's like $50,000.
Yeah, so just 1.5%. So we're not even where we were 2 months ago when we were at 2.5%. We're already past the 4%. If it was at 5% as it is today, you'd be eligible for $186,281.
Wow.
So 2.5 months ago, the house that you could have afforded would have been $253,000, and now it's $186,000. And your expendable income, disposable income, is not going to change the same as interest rates
Right.
are. Actually, it will probably go down because the whole idea with the Fed and changing the interest rates is to control inflation. So everything else is going up. The Fed raises interest rates to try to lower the effects of inflation, and that's what you get. So another thing that I wanted to point out before we get back into some other things is it's not the end of the world. Okay, we've just experienced some incredibly lowest in history, as a matter of fact,
Yes,
because I did the
historically
research.
low.
They were historically low. So when we were at 2.5% or lower, that was the lowest that they've ever been. So we went back to the 1970s. I pulled up some figures. In 1990, which is when my parents bought the house, the average for the whole year, the average interest rate was 10.13.
Oh my gosh.
So that was the average. That was what our last year in 2021, the average was 2.96.
Oh my gosh.
So you can see, and that was just the average. People pay, and in the late 80s, in the mid to late 80s, people were paying Well, in 81, for example, in 1981, the average was 16.63. That's what everybody on average paid for their interest rates. So, and you're locked into that, and people still had to buy houses, so you're locked into it. In 2020, the interest rate was 3.11. In 2002, so just 20 years ago, it was 6.54, and that's before the crash.
Right.
So that was just the normal. That normal average is right in there. So we're not far off from where we've been historically. We may have missed an opportunity to either refinance or purchase a home at a really great price, but we're not any further off than we used to be, and that'll have some effects on both buyers and sellers. So.
And you segue into a really good point. Interest rates might have been really low, but housing prices were really high.
Yeah.
Okay, so one of the effects that we are hoping the whole agents, the real estate industry as a whole, are hoping is what happens is the rising interest rates are going to cool the market a little bit and make it more balanced. So right now it's a seller's market. You could sell your house like that. We want it to be more of a buyer's market. So that means that housing prices might come down a little bit. That's really what we're hoping.
Right. And it's not that the houses are worth any less, it's people can't pay as much. So and that's the balance. That's the whole idea of the system is, well, you could charge that much for your house. And that's why we were seeing people bid $20,000 over or $30,000 over the asking price, is because they could afford it because the interest rates are so low. And you saw, like what I was telling you, the difference between a 5% and a 2.5% is $70,000. So you had that money that you could kind of fluctuate in there. So what's going to happen as interest rates go up, your expendable income is not going to increase. You're still going to only be able to afford max whatever it is. We're using this example of $1,000 a month. So if you can only afford $1,000 a month, then you can only afford a $186,000 house.
Right.
So that house that was once $210,000 or $230,000 is going to have to start resetting itself, because they're they're in a different buyer's market, and people are still going to want to live where they want to live.
Right.
So people are, and that's what will slow it down. You will not get as many offers on your house.
Right. But it'll still, I think it's still going to be
a
seller's market for a while. So
because of the inventory.
Right. Because you're still going to, inventory is low. Right. Because it goes quick.
Right, that's the reason why. You're still selling as many houses as before. It's just they
don't stay on the market.
They don't stay on the market.
Yeah. So you're still going to be able to sell your house. It's just you're really going to have to pay attention and work with your real estate agent to come up with a really smart price. The theory is if you price your home correctly as a seller, you're going to get more than your asking price, because there's going to be interest, because there's going to be a little bit of bidding, but you don't want it to necessarily be a frenzy, and it only takes one offer, right? It only takes the right offer. So, with that said, like you said, it's not the end of the world. So if you're thinking right now, oh my gosh, I've been thinking of buying a home in the next year, maybe I need to buy it right now. Don't rush into buying a home because you're afraid that interest rates are going to keep rising. They will. But I think if you plan to buy a home in a rush before you're ready, maybe you don't have as much money saved up as you had anticipated or whatever, I think you're just going to end up compromising too much. Sure. And that's what we don't really want buyers to do. If you can wait to buy a home until you're ready to find what you want, that's going to be more beneficial to everybody. So keep that in mind. Don't freak out, first of all. Second of all, I did want to mention that even though interest rates are increasing, if you do find a home that is the home for you, when you go under contract, that is when your lender locks in that interest rate. So let's say you go under contract today at that 5.1%, your interest rate there is locked in. So they can't increase it even if the day you close, interest rates have increased to 6.25. So you can't get locked into an interest rate until you are under contract to purchase a home. So yeah.
That's it. I mean, that's interest rates. It's tried to, like I said, keep it from becoming overly complicated. I mean, there's a lot that goes into setting rates. We don't have any control over that.
No.
It's out of our control. It's out of your control unless you work for the Fed. But, you know, that's what it is. And that's one of, again, hopefully this kind of shows one of the benefits of working with a realtor, somebody that can explain that. Keep an eye on things for you, remind you what you need to do. So.
I think that's about all I have.
All right. So you can find us on Apple Podcasts.
Yeah, Spotify,
Google,
Amazon,
and also YouTube. You can put our YouTube channel up there. And you can find Heather and I on Facebook at the Ford Realtors.
Yes.
And we're on Instagram.
Instagram at Constantly Varied Living. Yep. And our website, our brokerage website.
Which is the 1867collective.com.
Yep.
It's 1867collective.com.
Yeah.
And then also, please visit our YouTube channel, which is Constantly Varied Living.
Like and subscribe.
And put any comments you want or reach out to one of us. And
if you found this video helpful, or if you want to know more, if you have specific questions about interest rates or loans in general, we do plan to have a lender on our podcast, hopefully in the near future. So they will be able to answer those kinds of questions with more expertise. So thank you so much for joining us, and
we will see you next time.
Yep.
Bye.
Do you think Brad hates us?
Always.